Hello, good evening, everybody. Welcome to tonight's Equity Striker Stock Market Kopitime. I'm Benny Lee, the Chief Market Strategist for Equity Striker. All, if you can hear me, can you just type one or yes on the comment so that I know that you are able to see and hear me? We're gonna basically talk about a very interesting topic right now, right? About investing in the stock market and why this is the best time to invest in the stock market. Thank you, Senki. Okay. First of all, I hope that you guys already have your dinner. Good evening, Clara. Thank you for joining in. Okay. So basically, what I'm going to share with you guys is some of the reasons why we need to invest and grow our money. Because and also why now is the best time to invest in the stock market. But if you do not know what you are doing or what to do or how to build an investment portfolio, don't worry, because I will lead you into how we can actually help you to invest your hard-earned money into the stock market and grow your wealth investing in it. Okay. Now, before I start, whatever that is being shared here today is for educational purposes only. It's not intended as any investment or financial advice. If you need a financial advice, please do look for a licensed professional financial advisor. Okay. So what I'm sharing basically is our own take equity tracker on stock investment, and therefore the information that we basically going to share with you are the facts and figures, and without realizing, right, that without looking at the facts and these figures, we do not know what's going to hit us over the long run. So therefore, it is important, right, to remind ourselves what's happening right now, especially when it comes to finances and investments in Malaysia, right, so that we know what to do next. Okay. And of course, stock investment is not for everyone. There are many ways to grow your wealth. But here we are basically sharing with you why at Equity Tracker we believe in investing in stocks to continue growing your wealth. All right. Okay, first reason why. We all talk about inflation, right? And of course, those who earn money, maybe the young kids would not know yet how difficult it is and how expensive things can be today, right? For example, if you look at, let's say, about 15 to 20 years ago, a piece of roti canai, you probably could get it around 50 cents to 80 cents, right? And today, to try getting a roti canai for even 2 ringgit can be quite difficult if you're living in major cities like KL, right? But of course, you still can get cheaper ones outside of KL, in the kampungs and so on. But generally, if you are in KL, and these are basically prices in KL, right? It's just basically going up. Okay. Of course, when it comes to prices going up, this is just a symptom of why prices are going up. So later I'll share with you what are the causes, what's the main cause, right, for price going up. So what happens when prices go up is we have lesser spending power, right? If you still remember, if you take 50 ringgit and go to a shopping or go to a supermarket, right? 10 years ago with 50 ringgit, you can probably get a trolley full of goods, right? And you probably get, you can get a 5 kilo or a 10 kilo pack of rice with other things in your trolley. But today with the 50 ringgit, you probably just, get a packet of 10 kilo rice lah. Okay. So really, if you look over the long term, our spending power, if we're looking at the same amount of money, right, or same paper money that we look at, is basically the power of that ringgit that we have is just gets weaker and weaker over time, right? So this is the main cause of inflation, right? Every year, central banks will print new money. Okay, so because when you print more money into the markets, floating into the market, then of course our ringgit gets diluted. The value of the ringgit gets diluted, right? It's like basically if you are drinking Milo and you add more water and keep on adding more water, your Milo becomes diluted. It doesn't taste good anymore. So that's what's happening, right, in currencies right now. But of course, not only Malaysia printing more currencies, there are other countries that are also printing currencies as well. But if one country produces more currencies than the other country, then it becomes more diluted, and therefore we get weaker, right? And of course, that's just one of the reasons why inflation is higher. There can be other reasons as well, like money flowing out from the economy to another country's economy, and so on and so forth. Right. So if you look at the growth rate, right, from 1976, a long-term growth rate, 1976 to 2022, we can see that the money being released every year as an increment of about 11.6% a year, right? You look at 2012 to 2022, which is about 10-year period, it is growing about 5.3% a year. So we get more money printing out every year, about 5% over the past 10 years and 11% over the past uh, 40 years. You can see that because of the dilution, inflation or prices seems to get higher, right? So the important question is, are we growing our income higher than inflation? Okay. That comes to my next part, right? If we look at Malaysian inflation, it's nothing compared to the inflation that we see in the US or the Europe or any other countries, because their inflation is about 11%, 10%. But of course, in the US right now, they have brought down the inflation to about 6%, and Malaysian is still 3.4%, right? That's the rate, that's the inflation rate. That means prices go up generally about 3.4% every year. Okay. So that's the official figure, right? But if you really look at prices today of goods and services in Malaysia, when you go out and spend, you will find out that really it's not really that 3.4%, right? If you just use, let's say, that roti canai indicator or the teh tarik indicator, you find that prices increase higher every year. Okay. And a lot of course, business and vendors and so on and so forth, they use inflation as an excuse to raise prices even more, right? So although prices and goods and services gone up generally about 5%, let's say, or 3.4%, but they increase the prices 10%. And sometimes when we look at prices which are lower in price, like a 1 ringgit product, right? If it goes up 10% and you're paying 1 ringgit and 10 cents, it doesn't seem much. But if you look in terms of percentage of increment, it could be quite high, right? Even if, let's say, your kopi has gone up from 2 ringgit to 220 every year, that's already a 10% increment. Okay. But Bank Negara has actually come up with an approach. We have to be realistic in our inflation or perception of inflation. So in 2019, actually about 3 years ago, Bank Negara came out with a report that says, why cost of living perception differs from the actual inflation rate. Okay, so here they actually come out with a report. You can also actually get the report from Bank Negara. Just go to BNM website. You'll be able to get the 2020 report. And of course, you can also get the subsequent, more updated reports, right? So why Bank Negara is worried? Now, you always look at CPI, or Consumer Price Index, as a measurement of inflation, right? And because most of our products, most of our essential products, like oil, like petrol and all that, and even sugar, they are subsidized, right? And therefore prices is not as bad as in other countries. Like if you go and pump petrol in Singapore or even in Thailand, right, it's almost 2 or more times higher than what we actually pay in Malaysia. Even the price of sugar is much higher in Thailand. Even the price of rice is higher, right? So we are lucky because prices are controlled. But those are the basic items, right? The basic needs that we all, of course, use, and we are lucky for that because of the subsidies. But of course, when we look at generally what we spend, the prices are not controlled. The prices just keep on getting higher, right? So Bank Negara has come up with some other indices to measure inflation. Of course, this is not the official one, but basically give this indicator so that we want to really see what's the real inflation in price, right, over the years. So if you look at the CPI in the first column here, right, you see the annual change from 2010 to 2019. The growth is about 2.1%. So that's inflation rate for Malaysia. Averagely growth about 2.1%. Okay. But then they come up with an EPI. This are index of prices of frequently purchased consumer items. Okay, this one at least once a month one. Okay, so if you look at that part, we are looking at a 2.6% growth. And then lastly, it came up with this another indicator called the PEPI. This is a further refinement to the EPI, okay, where Bank Negara attempts to incorporate memory bias in addition to frequency bias. Okay, so it's basically the same calculation of EPI, but it only tracks the price increases. So if you look at the PEPI change, it's actually about 7.5%. Okay, so again, it's whether you look at perception-wise or reality-wise, but of course, this is when you look at PEPI, it also looks at the previous historical prices, right? So that's why there's a memory bias in there as well. So this is most as a perceived EPI. Okay. So if you look at this, really 7.5% is what really is being felt in the economy in general, right? Not really that 2.1 or the 3.4% inflation rate that we see in 2021, right? Now, so if you look at some of the figures here, you look at a growth rate, to be hand in hand or to be equivalent to the PEPI increase. Remember the PEPI, the 7.5% increase, that's generally prices of consumer goods that's purchased more frequently, right? You can see there's a 7.5% increase. Okay. Now, average wages over the past 10 years in 2010 to 2020, the 10-year change to about 61.5% change in average wages in Malaysia. If you look at the annual change, it's about 5.6%. Right, so our basically income in terms of wages, in terms of salary, it goes up about 5.6%. It's lower than the PEPI, right? And if you look at the housing price index, we're looking at the basic necessities, right? Consumers, goods that we need to consume every day, and also, of course, a roof over our heads, right? Prices of real estates or housing, right, has gone up over the past 10 years at about 9.3% annually. Okay, so our average wages gone up about 5.6%, PEPI is 7.5%, and housing price 9.3%. You can see the basic needs, the basic things that we need to pay for. The growth is higher, okay, than the wages that we see in Malaysia. So what do you think would happen? Okay, what do you guys think will happen? Okay, you can comment them on the comment if you have. Okay, I know there's some slight delay in our feed, but you have time, you can comment. So, of course, when we earn lesser than what we spend, what happens to savings? It goes down, right? So this is the after effect. You can see that the gross savings, okay, Malaysia in percentage of its GDP has actually declined over the years, over the 10 years. Okay, from about 34 to 34% savings 10 years ago, and today the savings has gone down to about 24%, down that 10%, which is quite substantial, right? And as long as the prices increase and we do not grow our income over time, that's what's going to happen to our bank account. That's what's going to happen to our savings. Okay, generally today, of course, it's really hard to even save money, right? Especially for those who are still young and go out there to find and to earn a living. Really, it's not like when we, like 20 or 30 years ago, after graduating from college, starting to go to work, although the salary was low at that point of time, but in terms of prices are much lower. Okay, but today, whatever people earn, they basically pay off their, whether the car or their, the house, or even food, and therefore left with lower savings. Okay, thank you, Senki. Yeah, people are just getting poorer, right? So now, of course, if your income can grow higher every year, that's fantastic. Right? If you can go higher, let's say if your income can grow about 10% a year, then it's not too bad, right? At least you're able to fight the inflation or the rise in price. But realistically, if you look at the figures earlier, our income only grew about 5.6%. So if your income can grow more than 10%, that's fantastic. Okay, and this data is up to 2020. We haven't factored factor in the COVID-19 pandemic effect, right? Where people lose jobs or even people get pay cuts. And even if you don't get any increment, was already quite good, right, for a lot of people. Okay, but then again, prices, you can't stop prices from rising because of inflation. Okay, so if we do not grow our income, right, then prices, then of course our savings will go down lower and lower and lower. So therefore, there is a very important need to actually get your money to grow higher. I know savings also quite difficult right now, but of course, there are always ways you can save. Right, we are not going to talk about that. Like buying cars, for example, right? Because cars is basically not an asset, right? If you buy a car, you buy a transport. Every year the prices just keeps going down. Okay, so it's not really an investment, and it basically just it's a major expense actually for a lot of people. So you probably need to find ways to increase or to lower the expenses. Not until you have to eat Maggi mee every day, lah. That's not a good thing to do, also, right? Yeah, Julius put another point, a very important point as well. Those days, less temptations to spend on stuff that you don't really need. That's very true, right? And today, social media plays a very, very important role in also to determine the lifestyle of a lot of people, right? So what I tell my kids, today, even I think they already know that whatever you see on social media, um, just take it with a pinch of salt, right? Not everything is real there. Yeah. But of course, it influences people, right? Today, during my time 20, 30 years ago when I started working, even if you get, a shirt like, a Guess or a Calvin Klein, is already quite high and is really quite expensive, right? We don't even think about brands like Gucci and so on and so forth. And at that point of time, of course, those higher end or very luxurious products were not available in Malaysia. You normally have to go to Singapore and get it, right? But today you have them here. So people like Julius has said as well, people get tempted, right? And of course, temptation, is not an easy thing to overcome, especially when we have peer pressures. Okay, but this is something that we need to do, right? Really, if we look at our income, if it doesn't grow in proportionate or higher than the rise in prices, eventually our savings will just get lower. All right. Now, not just savings lower, you can see that World Bank data also shows that Malaysians generally will not have enough savings for pension. 3/4 of Malaysians will have less than 1,000 ringgit and 50 cents, 1,000 ringgit and 50 monthly benefit at the age of 54 and above, right? And remember, when we retire, whether it's 54 or at 60, we probably still have another 20 to 30 years more to live, right? And therefore, with that kind of money, are we able to actually survive when we retire? Okay. So some people said, you know what, don't need to think about retire. Even now, also very hard to live already. Okay. So I mean, the very important questions we have asked ourselves is that, imagine if you have no income. Let's say you've got no work. How long can you survive, right? Do you actually have enough to maintain your lifestyle when you have no income, right? But of course, it depends on where you live. If you live somewhere in the kampong, you do not need to have so much money to maintain your lifestyle, right? But if you live in a city, then even for basic needs is much higher. Okay, so really to maintain even your lifestyle, not even talking about, let's say, upgrading our lifestyle, because like you see, savings are going down. But even to maintain your lifestyle, it could be difficult if we do not really grow our income in proportionate to the rise in prices. Okay, so why invest, right? I guess you guys know who Kennedy is. If you do not know Kennedy, then you probably go into much younger generation, right? But during our time, Kennedy is like the epitome of jazz, right? It gets people to get really interested in the jazz music. But Kennedy knows that, as a musician, the moment he stops writing music or start playing in concerts, he will not have income, right? So Kennedy today turns into stock picking. He basically invests in the stock market as well. You can Google about him. He always talk about Starbucks. He invested in Starbucks and some of the companies, very simple companies, but those returns has actually helped him to go through times when he has no income, right? When he's not performing or when he's not writing music. And of course, today you don't see Kenny G writing music anymore. He's more busy finding stocks to invest in. Okay. Now, the third reason why medical bills has also gone up. So we don't just talk about consumer food products, consumer products. You don't just talk about property. Another essential, factor or things that we need to really consider is our medical, right? So if you look some of the reports by, in this example, I give you two reports from two insurance companies. One is Prudential and AXA, right? They're looking at a medical inflation of about 12%. For AXA is about 15. So we're looking about between 12 to 15% increase in medical expenses over a year. All right. So you know that it's really getting more expensive. But fortunately, in Malaysia, we still can get free medical. Free means those um, not so dangerous ones are cheaper lah. But once you go into you go to a very serious illness or serious sickness, then it's really going to cost you a lot, right? So people can't even afford to actually get sick nowadays. Okay, so a lot of prices are increasing, right? No, so not just consumer goods, not just properties, but also medical, and these are all our basic needs. Okay, so basically, if we do not grow our income, right, of 10% a year, we are likely going to have financial distress in the near future. Okay, because our savings will keep on depleting. And today, we also know you can also go to Bank Negara and look at the statistics where household debt is getting higher as well. All right. Previously, 20 years ago, we are looking at household debt about 30, 40%. But today, that has almost doubled, right? Household debt is about 70 to 80%, which means that whatever income, right, that people have, 70 or 80% are in debt, right, of what they actually earn. So that's not a good sign, okay? And of course, the first thing, before you even think about investing is to get out of debt first, like, as much as we can, okay? Unless it's a good debt. Okay? If you get debt where your interest is low and you can invest your money and grow much more than your interest, that's a good debt. But make sure you can service it, like, in case if you do not have income to service your repayments. Okay, so this is very important, right? Because when we look at the data, where medical goes up about 12 to 15%, property prices go up about 10%, and consumer goods and products and services goes up about 7 to 8% a year. So if our income do not grow a minimum of 10% a year, then you really have to seriously consider either to get more income, okay, from any other sources, or to invest your money in the stock market, right? Now, why stocks? Okay, remember I mentioned to you there are many ways to actually grow your income, but why stocks? Stocks, among all asset classes, is one of the considered the most risky set of investment, right? The least risk one is you put your money into fixed deposits, okay? And we all know that fixed deposits probably give you returns about 3 to 4%, which is still lower than the rise of prices, right? So stocks basically give you an alternative, or it gives you an opportunity, right, to invest in good companies if you know what you're doing, so that if the company can grow and the profits can grow and the returns can grow as much as that 10% or more than 10% a year, that would be fantastic. All right. One of the stories that we always talk when it comes to investing in the stock market is Public Bank. Okay, we all know Public Bank, right? Is one of the not the biggest banks, but it's one of the bigger banks in Malaysia, right? Of course, Maybank is still the biggest, but if you look at invested, let's say if you invested, right, 72,000 ringgit of 100,000 shares of Public Bank in 2020, 20 years ago lah. If okay, 72,000, that 72,000 would have turned into 2.56 million today. So the 70,000 investment in Public Bank can turn into 2.6 million. Now, I'm not saying that you want to buy Public Bank right now, right? But but if you have bought it at 2020, then of course with just 70,000, even if you put 10,000 ringgit in, you still get about uh, you still get about 300,000, right, with the 10,000 ringgit. So you're looking at about nearly 3,000% returns, okay, in 20 years. Okay, 3,000% returns in 20 years. So if you just calculate it easily, right, 3,000%, you divide by 20 years, okay, that will give you about 15% returns a year. Okay, simple calculation now. Okay, annualize 15% returns. Okay, so if you hold it for 20 years, so don't look at the stock market and try to achieve very high returns over time. You just have to give it some time for good companies to perform. Okay, even with let's say 15% or 20% returns a year, it looks very small on a yearly basis. But imagine if you compound it over the years, and you will not know that your investment that you do today, right, even with 10,000, could turn to 300 to 400,000 or even a million ringgit in 10 or 20 years time. All right. So public vision is just one of the success stories, right? And of course, there are also a lot of other companies that we can invest in to grow maybe even better than what public bank can offer, right? Because there are about 970 companies that we can actually invest in Bursa Malaysia itself. And if you are not interested in Bursa Malaysia, today we are in a borderless world. You can also buy foreign shares. Okay, like you can buy US stocks like Tesla and Nvidia or Microsoft or Apple and all these kind of companies. So it is really quite limitless, right? But you just need to know how to invest and how to build your investment portfolio over time. Okay, so the other reason why we invest in stocks is because there's this book called Stocks for the Long Run. This is by Professor Jeremy Siegel. He's one of the renowned economists in the world. All right. So when he did a simulation, right, over the long term, you see that stocks still provide the best returns among other asset classes in the long run. Okay, so like here, if you look, stocks give you about 6.7% returns a year. Real returns, meaning real returns means you're looking at these returns minus off the inflation and so on and so forth. Okay, normally minus off risk-free investments. Okay, so you still get about 6.7% growth a year. Okay, whereas if you hold US dollar, basically over the long run, okay, this is about 100 years of data, right? You're basically not making any money from the dollar. Okay, if you hold the US dollar, right, 100 years ago, that's a dollar, but today it's only worth 5 cents. Okay, why? Remember, you talk about the dilution of currencies, right? Because of the printing of money, and therefore we have inflation. Okay. So when to invest, right? So we have why we need to invest and why the stock market. Like I said, the stock market provides an opportunity for us to gain higher returns, which I think is the only asset class currently that can actually beat the inflation rate that we see, rising. That the income that we need more than 10% a year. One of the legendary investor. He's also one of the richest men in the world, Warren Buffett, right? Who's been invested for more than 40 over years, 50 years. He is getting a returns of about 20 over percent or 20% a year, right? So even with a 20% growth over the long term can make you one of the richest men in the world, right? So of course for him, being a richest man, he actually don't need to work. He can retire. But today, okay, he's still investing because that's his passion. That's what he like to do, right? Um, if he do not invest in stocks, if he's not involved in stock investment, yeah, he once said that he's probably going to die younger, right? So that's his passion. Okay, but there is a way, right? And some you look at Warren Buffett investing philosophy is not so sophisticated. He just invests in business that he know can grow and business that he understands easily, right? So stocks basically have that opportunity. But of course, stocks is also risky for many people. Now, really, if you really know what you're doing and you really know how to build an investment portfolio, the stock market is not as risky as many people think, right? The reason why stock market is risky is because whenever we ask our family members or we ask our friends or whoever, we talk about investing in the stock market, they will tell you, don't stock market is so risky right? Um, don't invest in the stock market. Don't put your hand in there. You put your hand in the stock market, your hand is gonna get burnt. Okay, but we are hearing it from people that have experienced investing in the stock market, and most probably you'll find that they do not have a real strategy or plan to invest in the stock market, right? Most of the time, most of the investors basically make their investment decisions based on tips, based on recommendations from friends, based on rumors, and so on and so forth, right? They don't have a clear and systematic way of investing like what Warren Buffett has. Okay, so in Equity Striker, that's what we do, right? We have been, in fact, Equity Striker has been around since 1976, so we are almost a 50-year-old company, and of course, we have also provided education for the past 20 years. Okay? And what we do is we actually adopt the value investing principles, which Warren Buffett applies as well. Okay. Now, when is the best time to invest, right? So I give you an example of public bank earlier, right? The best time to invest, yes, was 20 years ago. If only I've invested 20 years ago, then today everything will be fine, right? But that was 20 years ago. And sometimes, even if you bought public bank 20 years ago, you may not hold it until today. You probably sold some when the price goes up 10% or 20%, or even when the price goes up 100%, you have exited, right? So you really need to have a clear plan to stick to an investment or a company that you invest in. As long as the company is doing well, we stick with it, or we probably add more positions, right? Now, if you look at the example I given to you earlier, with a 70,000 ringgit investment in 2020, in year 2000, right? That was one-off investment, 70,000. Now, imagine if you top it up every year, okay? Then you will have even, your returns will be much, much higher. Okay. So like I said, when it comes to investment, it's not just that you have to buy at the right price and at the right time. You need to have that consistency. You need to have that strategy that you know what you're doing every time when you invest, right? And when you have that formula, then investing will not be as risky as we think. And if you invest in good companies, it will just give you the returns, which is, like I said earlier, providing returns better than the rise in prices, right? So if it's not 20 years ago, then of course the next best time is now, right? Because we do not want to regret 5 years or 10 years later or 20 years later. In 20 years' time, you don't want to look yourself in the mirror and say, you know what, I should have invested 20 years ago. Yeah, that's what we do not want, right? But of course, we have to start the right way. You need to know how to really invest. If you do not know how to do that, then it's going to be very difficult. If you're just going to speculate in the stock market, then you're going to end up losing money in the stock market. Okay, but if you know what you're doing, then fantastic. Okay. So Warren Buffett, like I mentioned to you earlier, this is the guy that everyone or every investor looks up to, right? Because by investing, he became one of the richest men in the world. Okay, so in one of the AGM or general meeting that he has with his investors, every year he will have a general meeting with investors, and investors can actually ask him questions, right? And he will give out answers. He will give out some guides for us to investing. Now that's the beauty about the information that we have today, right? 20 years ago, you probably don't have much information. We don't have a lot of guide, right? Today, you just go on your Facebook or you just go on your YouTube. You have a lot of people, a lot of so-called investment gurus, right? That tells you, you know what, I've done this before. I can show you how to do it. It's like what we are doing now as well, right? But we are, again, we are investors, right? We just basically want to share with you guys. But then again, of course, people will, there's so many people actually teaching today. Why? Because they have the blueprint as well, right? So there are a lot of blueprints that there are a lot of wisdom that we actually can get from a lot of people today as compared to 20 years ago. Okay, but it's whether we can apply those principles or not. That's another question. Okay, so in one of the meeting, an investor actually asked, right? Um, I mean, you are doing very well, right, in investing. How do you do it? Okay, so Warren Buffett simply reply, right? So he just said that we simply attempt to be fearful when others are greedy and greedy when others are fearful. So this statement itself is actually very deep. All right. The first thing that we need to do is basically to change our mindset. Okay, so whether you want to listen to a successful person or you want to hear from someone from your family member or from your friends or whoever that's lost money in the stock market is entirely up to you, right? But the first thing we need to do is to change that mindset. Okay, to be greedy when others are fearful means what? It means that we should be looking for opportunities when others are afraid, when others are fearful. Okay, and of course, when everybody is greedy, that's when we start to be fearful a little bit. Okay, so if you look at the markets today, right now, um, what sentiment, what emotions that you think that the market has right now? Is it a greedy environment, a greedy sentiment, or a fearful sentiment? Okay, if you can comment them on the comment, right? Yeah, just basically, if you have any questions at all, you can just type in the comment. Then we can have a chat lah. All right, so that's what we want to do. We want to just basically have a chat here, right? So anything, even if you do not agree with me, just say that you do not agree. Then we just have a short discussion, right? So if you look at the market today, right, really there's a lot of fear. Okay, there is a lot of fear, and this is when people like Warren Buffett and people like us will be very happy because this will create a lot of opportunity. Okay, fear because every time you see inflation is going up, right? Prices are going up. Stock market index is going down every day. It goes up, and it's been going down. Prices of share prices are coming down, right? Income is going down. The only thing that's going up are those consumer products that we all use, right? So really, there's fear. There's fear of whether economy can be sustained, and so on and so forth, right? So, and that's the reason why you see the stock market, because of that fear, prices are going down. Okay, so we have a fearful market right now. Um, of course, there are times when markets are bullish, right? Prices are going up in general, investments are going up, because market doesn't go up all the time, right? It goes into cycles. Okay, even economy go to cycles. We have boom, we have bust, we have recession, right? And then we have growth, we have high growth, and so on. So markets and economy move into cycles, and if you understand the cycles, we can have an advantage, right? So when the market is greedy, then of course we have to be careful, right? And if you have made money in the stock market, it's probably time to sell. Okay. Yes, John, fear of war as well, right? We have tension of course, in the Ukraine and China war, which a lot of people say that it's a proxy between, U.S. as capitalists against the communists, uh, Russia and China, right? And of course, Russia is not a communist right now, but that's just the impression, right? There's a tension between U.S. and China. Yes, John. Okay. There's some greed, some fear. Yes, for those who are greedy, but of course, if you are greedy, even in the stock market right now, you cannot just simply invest, lah, right? You really need to have methods. You really need to find ways to build your investment portfolio. Okay. Thank you so much for your comments, Clara and John. Right. So when a market is fear, really, we should not follow the crowd of having these fearful thoughts as well, right? But of course, it's also not easy because to change your mindset is something that is not easy. Everybody is not investing, and if we go and invest, then it's like, wow, what happens if I'm wrong, right? As humans, we have this herd mentality lah. We follow crowds, right? Because it's always a safe place to be. Okay? It's like if I follow the crowd, if I'm wrong, the whole crowd is wrong. Everybody is wrong. So we all face the consequences together, right? But if we go against the crowd, like if I am wrong, then the crowd is going to be right. Okay, that's always hard to accept, and that's the reason why, because of peer pressure, it's just human emotions, right? That we have to basically fit in the crowd. Yes, to a certain extent, we need to follow the crowd, okay? But when it comes to investment, that's when we need to change our mindset. So at the moment when there is fear, okay, we have to be greedy. Greedy means we have to find the right opportunity or right um, shares to invest or to build into your portfolio, right? Now, this is one of the reasons also why investment now will be interesting. This is more technical, so I'm going a little bit more technical. This is the KLCI chart, okay, from 1986 to the current level. All right. From 1986, you can see there's a crisis before 1985, 1984. There was also a recession at that point of time, and then we have the 1997 peak here. Okay, and we have the Asian financial crisis. Okay, and you still remember that point of time, our then Prime Minister Tun Mahathir actually pegged our ringgit 380 to a US dollar, right? So the crisis actually turned our index down, falling from about 1,600 points, which is where we are today, right? 1,600, 1,004 to 1,600 points. It went down all the way to 200 points, right? And if you bought public bank, let's say not in year 2000, but you bought public bank in 1997, for example, right? Your returns could have been much, much, much more. All right. And then the market recovers, right? It starts to go higher. And you also find that during bear market or bad markets, the period is always shorter than the bull markets, right? The good times are always longer than the bad times. Okay. So good times means, so the fact is that good times does not last forever as well. Okay. You need to have some short-term pain. The market needs to be corrected. Okay. You cannot enjoy all the time. Okay. But the correction takes a very short period of time before the market recovers. Okay. And the good thing about when market recovers, it goes to a new high, right? Like after the Asian financial crisis, we see market starts to be bullish again. It keeps on making new highs, right? In 2008, it was supposed to go higher, but then suddenly we have this US financial crisis, right? The subprime mortgage crisis turned into a financial crisis in the US, which in turn turns into a global financial crisis as well. So that's when we see our index fall from about 1,600 points to about 800 points. Again, that's a very short period of time before we have the quantitative easing, right? Where money is being pumped into our markets, in financial markets, and we can see um, stock market moves into historical high again. Okay, so in 2014, that's when we see the peak. All right, in 2018, it tries to break the peak before this, but then it cannot, and then it has been bearish since. So if you look at the stock market, actually, if you look at these price movements here or the index movement, we have been in a bearish market since 2014. But bear in mind that the index, right, the KLCI only made up of 30 companies or 30 shares, right? It does not really represent um, all the companies in Bursa Malaysia. Okay, so although index may go down, but you can see some companies in some sectors where the prices are still increasing. All right, but it's just that the market sentiment is low, so the index gets lower. So what we can see here on this chart movement, right, over the long term, okay, from 1985 till now, you can see the blue and red area, right? And in the middle, we have the middle line. Okay, so this is basically a linear regression line. So in statistics, a linear regression is basically average price lah. All right, it's the average price. Now, so this is the average price, the middle line here. This is the average price over the long term. And you can see the average for the KLCI is now supposed to be at 1,800 points, right? In order for this growth that we see here over the past 40 years to continue, right? It needs to go and trade around 1,800 points and beyond, right? But what you can see here is whenever there's a crisis, okay, the index moves to the bottom band, okay, the red area. That's when it's a bearish market, right? In a long-term uptrend, you can see that at the bottom of the crisis, it hits the bottom line, right? During peak of economic activity or financial markets, you can see it hits the top line. Okay, and where the KLCI is at today, right, of this linear regression channel, it is near the bottom. Okay, the bottom line of that channel. Okay, and you can see that whenever the KLCI hit the bottom line, that's where the bottom is, right? And markets rebound, and it should continue that trend. Okay, because if the index goes below, let's say 1,300 points, that means that trend that we see here in the past 30 years or so, right now has changed, right? And we hope we do not see that happen, all right? But really, if you look at this, the index is really quite low, okay, in terms of the growth that we see over the long term, and therefore, and of course, this is the index, right? The index has come down probably about 20-30%, but there are stocks that has gone down 60%, 70%, right? Much lower. So there are actually quite a number of stocks where share prices are low, but doesn't mean that the company is actually not doing good, right? Sometimes people also sell, or investors sell shares in companies that are doing very well simply because of market sentiment. People, they follow the crowd. When everybody is selling, when they see fear in the market, they just sell the shares, take the cash, and become defensive, right? Put their money into FD and keep it safe there. Okay. But for Warren Buffett, again, for most investors who know what they're doing, it's time to actually take out the money from fixed deposits and savings and start to find opportunities in investment. So all we need to do is basically to find the right companies to invest in, right? Because like here, okay, I mentioned to you, this is also one of the reasons why it is, really a good time to look for investment now, because market, like I said, move in cycles, and therefore we probably see an opportunity that probably lasts in decades. Okay, so if we miss this opportunity, we probably have to wait the next cycle when the market bottoms out again in the next decade or two, right? So this is an exact time. It's like telling myself, if I don't invest now, I'll probably regret if the market starts to rebound and go up higher in 10 or 20 years time. So I'll just tell myself, I should have invested 10 or 20 years ago. Okay, so really that's why we need to invest now. So what I'm basically sharing with you is why we need to invest and when. Okay, and you would like to know further about how to do it. Okay, and what to invest in. I would really encourage you to join us on our next seminar. It's going to be a physical seminar. It's not going to be online. What we are doing here is online, right? But we're going to do a physical seminar on a Saturday morning, right? Just spend 2 hours with us, and we're basically going to share you even more details. You already know why and when, and the next thing is what to invest in, right? And how. And if you join us, then we're of course going to continue to share with you further on what to invest in and how you can also start building your investment portfolio safely. All right. So every month we will have the stock investment GPS seminar. All right. So GPS basically says, GPS is global positioning system, right? It tells you direction. Okay. But for us, GPS also means grow your profits safely. All right. Grow your profits safely. I'm going to emphasize the word safety here. Right? We do not want to treat the stock market like a gambling den. We do not want to speculate, but we want to invest safely because we all do not want to lose our hard-earned money. Okay, and therefore it's important to know how to invest, get the returns that we want. Okay, minimum that 10% returns. If you can get 20-30% returns, that's fantastic. But we have to do this safely. So come and join us on the 11th of March, 2023, which is 3 Saturdays from now. Then we will share with you guys more. All right. So you can basically scan on the QR code over here, or you can also click on the link that we're gonna share with you in a short while. All right. So just click on that link to register. You have to register. You just don't walk in, right? We will not accept any walk-ins because our seats are quite limited here in our office space in Equity Striker. Right. So this is only by registration. So please do click in and click on the link. And if you have any friends you think that are interested in investing in the stock market, all right, join us. And we do hope that we are able to share with you more on that Saturday, 11th of March. and also share with you how we can help you to invest safely, all right, and get the returns that we want. Okay. So that's basically my presentation for today. If you guys have any questions, you can ask me questions. If not, I'm just going to leave this on for about a minute. If there's no questions coming in, we can have a chat right now, right? Any questions relating to investment or any questions, but it has to relate to investing, then just shoot those questions here. If not, then I'm going to end this session. All right. And also, I want to thank everyone for joining us tonight in this session. Remember, we're going to have this session every Wednesday night. All right. Unless there is not, then we will just inform that we're not going to have this. But every Wednesday, we want to engage with you guys so that, if you think that is interesting, please, the recording will be available. You can share this with your friends for those who are interested to grow their wealth in investing in stocks. Just share this, or you can even share the link that I show you so that they can join us on the 11th of March. All right. So thank you, Clara. Thank you for joining us. Thank you, everyone. If there's no questions, then I'm just going to end. If you need any help, then just do the comment and we can answer you later. Oh, Julius. Okay, thanks. Do you believe another dip will come? Well, it depends on what dip you're looking at, right? It depends on stocks. Now, when we invest in the stock market, we don't invest in the index, right? Because the index is a aggregate of 30 companies or 30 company share prices. Okay. So whether there will be another dip, the market is still in a fearful mode. Yes, we're probably going to see another dip, right? But nobody can actually know where the market bottom is. Okay. But by looking at the chart, we know that yes, it's already down quite aggressively. It's better for us to invest right now than if compare that you bought shares last year, right? So if you bought shares last year, today is going down, you feel a little bit more hurt. Okay. It doesn't mean that you should not buy some more or you should sell your stocks, but you just need to rebalance your portfolio and basically add in good stocks so that when the bull market comes, I do not know when, right? It's just now is a good time to find opportunities, right? You just need to know that just need to have a strategy to know when to buy shares. Okay, as even if the price comes down, it's okay, right? Because if you buy in good companies, you should not be fearful. Okay, whether there's another dip will come. If you look at the index point of view, I don't see any more dips unless there's another crisis, right? Unless there's another crisis, anything can happen, right? I mean, a war can break out, another financial crisis can happen. But if not, then we probably, in my point of view, we will not probably see another dip on the index. Okay, but in terms of individual shares, it depends on that share prices. So we really need to look at individual shares, to know whether there will be another dip or not, because that depends on the performance of the company, all right, over time. So to let us know whether the share prices can fall further or not. But other than that, if you ask me just on the index itself, well, I think we probably see a bottom for the index. Okay, Julius, I hope that answers your question. Okay, any more questions? Okay. Well, I'm going to end the session here tonight. If you have any more questions, you can just type in there. And I have time, I'll look at it and I'll answer the questions in the comment itself. Okay. If not, if you want to ask us some more questions, then please, feel free. We really encourage you to join us on the 11th of March, 2023 at 10 a.m. Okay. So with that, thank you very much for joining us. See you again next week. And have a good evening, everyone. Good night.